Hello and welcome back to the Legend Finance channel. We're glad you're here. If you're new to our channel, don't forget to subscribe to stay updated on all our financial discussions. Today at Legend Finance, we're focusing on a topic many people think about but aren't sure where to start: paying off a mortgage early. It may seem like a steep mountain, but with the right strategies and a bit of patience, it's an achievable goal. By paying off a mortgage early, you can gain significant financial freedom and save on interest over time. Doesn't that sound great? It's a challenging task, but with careful planning and a bit of discipline, anyone can do it. So stick with us as we break this down, share strategies, and discuss how to make this dream a reality. Let's aim to get your money working for you rather than your mortgage. Are you ready? Let's dive right in. Mortgages. So imagine you're borrowing $300,000 from the bank to buy a house. This is a fixed-rate mortgage, meaning the interest rate is set at 4% and won't change for the next 30 years. Your mortgage payment every month includes two things: the original amount you borrowed, the principal, and the 4% interest charge. Now, the bank doesn't leave it to chance. They use something called an amortization schedule. This is just a fancy way of saying they figure out exactly how much you need to pay each month so that by the end of the 30 years, you don't owe them anything. It's all taken care of by the amortization schedule. Even if you decide to pay extra each month or drop a chunk of change to lower the original amount you borrowed, the principal, your total monthly payment won't change. What does shift from month to month are the parts of your payment that go toward the principal and the interest. The amount of interest you pay is tied directly to how much you still owe the bank. If you think about it, your first month is when you owe the most. Got it? You start with $300,000, right? Here's a quick bit of math for you. 4% of $300,000 is $12,000. Split that up into 12 months and you get $1,000 each month. In your very first payment, you're looking at $1,000 just for interest. This is the most you'll ever owe in interest because your total monthly payment is $1,432. So out of that $1,432, $1,000 covers interest, and the rest, which is $432, chips away at the original amount you borrowed, the principal. This same kind of calculation continues each month. So in 2 months, you've already made a dent of $432, twice in what you owe. This is your principal reduction. Then they take what's left of your loan, multiply it by that 4%, and divide it by 12. That's the interest for your second payment, and anything you pay over that goes to reduce your principal. It's a pattern, really. Your monthly payment stays the same, but each month a bit more of it goes towards the principal and a bit less goes towards interest. That's because as you make payments, you owe less and less to the bank. Suppose you don't fancy paying all that interest over 30 years. The trick is simple: owe the bank less money. Now, something some people don't get is that with this kind of mortgage, the interest only builds up monthly, not daily. So whether you pay on the 1st, the 10th, or even the 15th, it makes no difference. Your amount owed stays the same, and you don't rack up more interest by paying later in the month. Now, this isn't how all debts work. With credit cards and home equity lines of credit, the interest piles up every day. So for those, you'd save money by paying as early in the month as you can. It's a little different than mortgages. Alright, team, let's pretend we're messing around with an online mortgage calculator. We're sticking with our example: a $300,000 mortgage at 4% interest over a 30-year span. Now, what if we toss in some extra payments on the principal every so often? It'd be cool to see how much quicker we could get this loan paid off. Just to jog our memory, we're dealing with a $300,000 mortgage over 30 years at 4% interest. This gives us a monthly payment of $1,432. So let's pretend we're scrolling down to the bottom of this calculator, right? It shows the total payments over 30 years, and whoa, it's over $515,000. Out of that, over $215,000 is just interest. You might be thinking, wow, we could have bought another house with that. But that's how it works. If we're borrowing $300,000 for 30 years, that's the interest we're dealing with. Now we might think, no way, we're not paying that much interest. What if we cut the mortgage to 15 years instead? The interest over that period drops to about $100,000. But look at the monthly payment. It's leaped from $1,432 a month to $2,219 a month. Let's head back to our 30-year mortgage example. Suppose we get a tax return of about $3,000 every year. Imagine we use that to pay extra on the mortgage each year, say around April, or whenever we get the return. If we do that, we'd save a whopping $61,410 over the life of the mortgage. And get this, we pay off the whole thing in just 22 years and 5 months. That's over 7.5 years early, just by tossing an extra $3,000 at the mortgage once a year. Now, let's say we can't manage the 15-year schedule, but we can spare an extra $400 a month. By doing this, we don't have to pay as much interest over 30 years. In fact, we save an amazing $81,000 over the life of the mortgage. How cool is that? So with that extra $400 a month, we'd be totally done with this mortgage in just under 20 years minus 19 years and 10 months to be exact. And we'd have saved ourselves a nice $81,000 in total. Now let's switch gears and take a look at how home equity lines of credit work. Home equity line of credit. A home equity line of credit, or HELOC for short, is kind of like a credit card, but your house is the security. To get one, you need to apply, have some equity in your home, that's the equity part, and a pretty decent credit score. The big difference between a HELOC and a mortgage is how they handle interest. For a HELOC, the interest is calculated daily, not monthly like a mortgage. So let's say you borrow $10,000 through your HELOC. That interest starts building up every single day, not just once a month. They figure this out by taking your interest rate, maybe it's 5%, and spreading it over all 365 days of the year. Then they check your balance every single day to calculate the interest. It's a different ballgame compared to a regular mortgage. They're basically keeping tabs on your interest every single day, and then at the end of the month, they add it all up to figure out your interest payment. Because of this daily interest thing, it's actually cheaper if you pay on or before the due date. Waiting could cost you more, especially if you don't pay until 10 days after your due date. Remember that interest keeps building up each and every day. Imagine you borrow $5,000 through your HELOC and then pay it back. It's available for you again, kind of like a credit card. It's not too tough to wrap your head around. Now, some videos talk about this concept called velocity banking, where they claim you could pay off your mortgage in just 5 to 7 years using a HELOC. Basically, you've got your mortgage, you take out a HELOC, and you use a big chunk of it. So picture this, you take $10,000 from your HELOC and use it to pay extra on your mortgage. That directly cuts down on your principal balance. And because you owe $10,000 less on your mortgage now, you're going to pay less interest, even though your monthly payments stay the same. So more of your payment goes toward reducing the principal, which speeds up how quickly you pay off your mortgage. But there's a catch. You now owe $10,000 on your HELOC. Velocity banking. What's that? Well, it's when you use your HELOC like it's your regular bank account. So when payday comes around, you put your money straight into the HELOC instead of a checking account. This immediately reduces the amount you owe on the HELOC. Then you use the HELOC to pay your bills, and you keep doing this process, paying into the HELOC with your income and paying your bills out of the HELOC. The idea is to aim for getting it back down to zero, then start the cycle again. It's an alternative to letting your money sit in a bank account without earning any interest. So with your money going into the HELOC, instead of just sitting in a bank account, you're actually reducing the interest you owe on those days because your balance is lower. Then when it's time to pay a bill, you use the HELOC, just like a checking account. This velocity banking idea could potentially work out if you're super diligent and keep a close eye on it. The danger is if you start thinking of the HELOC like free money and end up spending more than usual. But if you're disciplined and really stay on top of this, it could save you some money in the long run. Honestly, we feel like this might just make things more confusing, and really it's not even needed. But hey, if you're set on getting that mortgage paid off early and that's where your focus is, we've got 5 tips to help you on your journey. Extra cash? Put it towards your mortgage as a principal payment. 2. Consider bi-weekly payments. You'll end up making an extra payment each year, trimming time off your mortgage. 3. Try paying like it's a 15-year mortgage. If you can afford it, this can speed up clearing your mortgage. 4. Look at your interest rate. With today's low rates, refinancing could offer big savings, but weigh it against the closing costs and your stay's length. 5. Use a home equity line of credit as an emergency fund. Then use some of your current emergency savings to further reduce your mortgage. All right, folks, that's a wrap on early mortgage payoff strategies. Excited to put them into practice? We hope so. Don't forget to like and subscribe to Legend Finance for more of our insights. Got any questions or topic requests? Comment below. Until next time, keep hustling for those financial goals. See you soon.